Read this headline from 2022, what a recession means for the return to office battle between workers and companies. Obviously, we're no longer in 2022, but the reason why I wanted to reference this article is because back in 2022, we were still worried about a potential recession. Obviously, things have changed now. People are more worried about a recession today. But back in 2022, that was when we started to see more and more of that start of the return to office push. And that was when people started to hypothesize what an economic slowdown would mean for this return to office trend. And I want to talk about how that has changed between then and now, because we have seen a shift in the work dynamic between then and now. What does that mean? Well, back in 2022, we were still a job seekers market. That means companies were more desperate for employees than employees were desperate for a job. If we compare that 2022 job market to today in 2024, well, now what we're seeing is higher unemployment. We've seen wage growth slow, we've seen hiring slow, and we've also seen layoffs increase. It's a very different dynamic. And what the article talked about is that the shift of being able to go back into the office will happen when we see bargaining power shift between the worker and the boss. In other words, even in 2022, employers wanted to get back to the office, but they were facing a lot of backlash. Employees were protesting. They said, I'm not going to do that. Employees said that we're going to leave. And so employers were given kind of a lot of pushback saying, maybe we don't go back to office because we're going to lose a lot of people or it's going to create a lot of controversy. But if we start to see a shift in the power dynamic where employers have more power, because back then every employer needed employees and it was just a very different dynamic. Now we're starting to even out where employers and employees are starting to see more of an even balance. Well, we're also starting to see that shift change as well. And that's also partially why you're continuing to see this trend of returning back into the office in 2024 with more employers saying get back into the office or leave the company. Another way we've been seeing this shift happen is back a couple of years ago. Quiet quitting and the Great Resignation were very powerful. What that meant was a lot of employees said, I'm only going to do what the job description says. I'm not going to do any more. And maybe I might even do a little bit less. Maybe I'll kind of go on vacation and not tell my boss. Maybe I'll do other things and just relax and take it easy because, well, if my company lets me go, I can go and get a raise at a different company down the street. That was 2022. Today in 2024, it's the opposite. You're seeing more things like quiet layoffs. What is that? Well, this is where some companies are saying, you know what, we're going to mandate things like returning back into the office because it's an easier way for us to see who really wants to be a part of the company and who doesn't. Because based on our finances, we're going to have to let people go, and it's easier if people just leave on their own. So let's see what happens. And that's why today I want to talk about the job market, but not in terms of remote work versus in-office work, and not about quiet quitting. I want to talk about why employers are needing more productivity, why employers are focusing on more growth now than what we've seen over the last 4 or 5 years. So let's jump right into that. But first, a quick reminder that on August 15th, 1971, that was when our dollar was taken off of the gold standard, which changed our money forever. And that's why this year on August 14th and 15th, I'm going to be hosting our biggest investor workshop of the year. It's virtual and it's free, where I'm going to be going over, number one, how our money has changed over the last 5 decades and also over the last 5 years. But I'm also going to be going over, number two, how you can build wealth in this changing economy during a time where there's a lot of craziness in the economy, there's a lot of craziness in the markets, and we still have the higher inflation, we still have the higher interest rates. How can you find financial trends? How can you find opportunities? And how can you build wealth? Because yes, there are opportunities here. If you understand what's going on, I'm going to be going over all of that in this Investor Summit for free. So if you'd like to join, I got the link for you to register down in the description below. Now, in order for you to understand why this shift is happening in the job market, you got to understand what fuels our economic system. Our economic system runs on spending. When you go to Chipotle and you buy that bowl, Chipotle makes money. They have money to hire employees and open a store. But when you go to Chipotle, you buy the Chipotle bowl and you buy the extra guac, well, now maybe they can hire more employees, open an extra store. Now, of course, it's not just your extra guac that's going to make it work. It's the extra guac collectively across all the Chipotle stores. When companies make more money, they have the ability to hire more people, open more stores, because companies want to grow. They want to expand. They want to make bigger profits, and that means they're going to have to reinvest money back into the company. But they can only do that if the company is making money, because if you walked into Chipotle, you open up your wallet and say, oh, not only can I not afford your extra guac, I can't afford your bowls anymore, and you walk right out. Well, now Chipotle might have to start letting some people go. They might even have to start shutting down some stores. Maybe they'll have to start looking at their portion sizes again. But this is where Our economic system runs on spending, but it's not just spending. Our economic system is a credit-based spending system. That means you can earn $100 and spend $150 thanks to lines of credit and debt and home equity, other types of credit. So our system runs on people spending money and people spending money they don't have. What that means is you can make $50,000 a year and spend $65,000 a year because of debt, which is good for the economy. It's good for the economic system because that means you can spend more money today, you can have more money today, you can grow the economy, businesses can make more money, but that also has a consequence because if you spend too much money, well, then you might have to pull back on your spending. And now if you have to pull back on your spending, the opposite starts to happen. Because now if you reach a point where you max out your credit cards and the bank says, you know what, we're not going to extend you any more loans. Now, instead of spending your extra money or money you don't have on the extra guac at Chipotle, now you're going to have to make some lifestyle choices because you can't keep spending money. You might have to declare bankruptcy. You're not going to be able to spend more money because every credit card is going to get denied. And Chipotle is not going to give you a free bowl and guac because of a big hug that you can give them. They want money. And if you can't pay them, they're not going to give you the guac. So now, if you reach that point, now you got to cut back. Maybe you stop buying the extra guac. Maybe you start cooking at home and you don't go to Chipotle. Maybe you stop buying the organic foods. Maybe you start buying less stuff. Maybe you start buying smaller stuff and less things. Now, when you do that, less money is going in the economic system because you have to spend more money paying down your debt. You have to spend more money paying down your credit. What does that create? Well, that's the big reason why we see booms and busts in our economic system because people have a tendency to overspend. This isn't something that just started in the last 5 or 10 years. This is something that has been going on for decades. In this economic system, people will spend when they have the ability to spend, and banks love it because they get to make that interest. Corporations love it because they get to sell more stuff, and people love it in the short term because they get to have the Gucci, they get to have the BMW, they get to have the guac until you face bankruptcy. Then it becomes a problem. Then you hate everything. Then you hate the bank. Then you hate the corporations. Then you hate your job. Then you hate your landlord. You get the system. But this is where now what we're starting to see happen today is more and more Americans are starting to get tapped out. And not just that, more and more Americans are starting to pull back on their spending. The reason why this is significant is because the first time that we're now seeing Americans pull back on their spending since the pandemic started. It's the first time we're seeing people ask for discounts. It's the first time we're seeing companies saying, we're going to start promoting a value menu. Because people and companies are realizing that Americans are running dry on how much ability they have to spend. And because of that, some businesses are starting to make less money, or they're starting to see that they're not going to see the same revenue growth and the same profit growth as they've had in the previous years. So what does that mean now for a business? For a business, what that means is, well, your costs are rising because of inflation. Salary costs are more expensive today than 5 years ago. Rent costs, because businesses that have offices, they got to pay rent. They're more expensive today than 5 years ago. Expenses and softwares and everything is more expensive for a business. So businesses have higher costs. And if they've been projecting higher growth, their investors are going to expect higher growth. And the CEO's salary is probably somewhat tied to how good the stock value is doing. And if the company isn't making money, the stock value might not be going up like what they hoped. This creates a problem. Now the CEO has to say, okay, we need to continue growing this company because the economy is not going to do it by itself. The economy is not growing like what it was before. Before, every company was making more money because the economy was booming. You don't have to be a genius CEO to see growth because the economy was doing that growth for you. Today, the economy is not doing that same growth for you, so CEOs have to figure out how can you grow the company yourself. So now as a CEO, as you figure out how can we grow the company, the first thing is we need to make sure we have good employees because a lot of companies overhired or they just hired anybody because they needed employees in 2021 and 2022 and even a little bit into 2023. So this is where now CEOs are pushing for more productivity, they're pushing for more efficiency, and they want to see who are the right team members. This is why we've been seeing a lot of layoffs in many different industries because companies realized that they got a little bit too fat, they got a little bit too bloated. Now the next thing is companies are trying to figure out how can they be more efficient because companies are realizing that if somebody is doing remote work, you might go and get your oil changed at 11. And if your boss needs an assignment at 11:15, they send you a message on Teams, they send you a message on Slack, they send you an email, and now you're at your oil change and they have to wait 45 minutes, that starts to slow that process down. And this is where more and more companies are saying, okay, We got to figure out how we can continue competing. We have to figure out how we can continue to be more efficient because your competitor is starting to go back in the office. And maybe they're being more productive because they're in the office. Now you might say, well, I'm more productive at home. I'm more productive when I can do things on my own schedule and I can take care of my kids, I can take care of my parents, and I can do things around the house. Well, your corporation is saying, yeah, maybe for you it's better, but for the overall company, it might not be. This is why we're seeing a bigger shift. Now, you can hate me, you can love me, I don't really care. What I'm trying to get you to understand is what's happening in an economic system. That way you can build wealth. That way you don't get slapped by what's happening. I want you to understand what's happening instead of getting blindsided by it, because the reality is the majority of people get blindsided. They don't understand what's happening, and then they don't understand why things never work in their favor. I want you to be financially educated and understand how the system works so you can understand what's moving the system. That way you can find the opportunities. Now, of course, another thing that we're seeing happen is we're seeing more layoffs, we're seeing more company defaults. And so if you like your company, if you like your job and you want to stay at this career, you got to understand that companies are looking to keep only the best team members now. They're only looking to keep the best employees because companies are looking to downsize. They're looking to only keep the best people. So if that's you, you got to understand that you better be coming in and putting in the work. That way your company understands that, because companies are now looking for the right people and they're looking to be more efficient. We're seeing a push for efficiency. We're seeing a push for productivity. That wasn't the case in 2021. That wasn't the case in 2022. It was a little bit of the case in 2023, but now it's really becoming the case, and I want you to understand this, because if you don't like your company, well, then this is the time to start looking for a better company, a better career, find an opportunity that works for you, because yeah, there are some bad companies out there, but there are also some great companies out there, and you want to work for a company that aligns with what you want to do, that aligns with the mission, and that can pay you well as well. Yes, there are some great companies out there. That might mean you got to put in some extra work. That might mean you got to hustle. That might mean you got to put in some extra time to learn some new skills. But if you're willing to put in the work, well, then you're going to be able to see the opportunity as well. If you go into default, you declare bankruptcy. That means not only are you not paying this interest back to the bank, but the money that the bank lent you is gone as well. We've seen this happen before. We all remember the Silicon Valley Bank collapse that happened not that long ago. Well, Silicon Valley Bank was in the business of lending money to startups.